So I can see it in your eyes, and I know a big reason you came today was because you want to learn more, since we've introduced it right here, about this whole accounting thing. Of course, I'm talking about debits and credits. We've got a page on it. Go to the next page in your workbook. Let's just talk about how these things work. Folks, what is a general ledger? Very good. It's a place where you write down your financial transactions. Now, it actually, how many of y'all are old enough to remember when it was actually a book? It was actually a book. And accountants had very nice writing, didn't they? Awesome writing. In fact, I believe there should be a font called accounting font because it was so nice. Like draft people that did drafting, they have really nice font too, right? Yeah, it's a book. And today, usually a system, software like QuickBooks and others, that actually has a structure where we keep track of an entity's financial transactions. So that's what a general ledger is. Now, a couple things about this ledger. First of all, in double entry bookkeeping, every transaction has both a debit and a credit. Now, debits happen on the left and credits happen on the right. That's it. You see the structure in the middle of your page? Okay? Debits happen on the left, credits happen on the right. Now, I'm about to go into some territory that could be confusing. So this is my danger, Will Robinson. Danger. Danger. Okay? If the only place you've actually heard of debits and credits is within the context of your checkbook, all right, the material I'm about to go over with you right now is something you just have to memorize. How many of you all who know anything about accounting agree with me that the next thing I'm about to show you, which is what the directions of the debits and credits signify or mean in the structure of your ledger system, it's something you just have to memorize? Okay, good. Now, we're going to talk about journal entries, adjusting entries, and closing entries here in a second. But first, I want you to focus on the middle of your page, and we're going to talk about what debits and credits represent, first for asset accounts. Now, down in those T accounts, by the way, why are they called T accounts? Because they look like, that's nothing more complicated than that. They just look like a T. And if you've ever had a conversation with an accountant, sometimes they may have actually said, hey, how's this going to work accounting-wise? They may have actually drawn some accounts. You ever had that experience? Yeah, the T accounts and showed you, well, here's the debits, here's the credits. Very, very gripping conversation that you can have. And this is actually information that once you learn this, and when I teach the Excel class, when I teach Excel, I tell people this too. This is actually stuff that it's really cool to bring up at parties about how smart you are. It's what the direction of, yeah, this is good stuff. You ready? So you're going to do these up and down arrows that I draw up here in those T accounts in the middle of your page. All right? Asset accounts. A debit is an increase and a credit is a decrease to the balances of those accounts. You're going to say why, and I'm going to say it just is. I normally don't tell that to people. I normally teach people to question everything. Don't question this. Don't question this. Okay? Liability accounts. Now, asset accounts are on this side of the balance sheet. Liability and equity accounts are over here. So what do you think the direction of debits and credits are going to be? Opposite. Good. For both liability and equity accounts. It's just the opposite. All right. Now, those are the three basic balance sheet accounts. Sometimes those are referred to as permanent accounts. I don't want you necessarily to write that down. These accounts always have balances. But the two accounts down below them, and what I'd like you to write in that box, are operating accounts. Revenue and expense accounts are operating accounts. And there's something very special that happens with the operating accounts at the end of an operating period. We're going to talk about that here in just a second. But with revenue accounts, a debit's a decrease and a credit's an increase. And so what do you think expense accounts are going to be? If you're thinking but are afraid to say it, just the opposite, you're absolutely right. A debit's an increase and a credit's a decrease.
So this is just something I should have on my wall at home?
Yes, on your wall at home. Right there in your mirror next to where you look at yourself when you shave, at least for the next 30 days. That's right, Josh. It's just something you have to memorize. Now, within the context of that, so you got the directions of the debits and the credits, we're going to go back up to the top of the page and talk about the different types of events that happen in the business that cause transactions to happen down in these accounts. Journal entries. All right, journal entries are basic business events. Just write that down, they're business events. So back in my purchasing system, and by the way, usually, almost always, placing a purchase order or placing an order with someone does not create an accounting transaction. It does create a commitment in your purchasing system, but it usually does not create a debit and a credit in your accounting system. All right? But let's say we have a bicycle manufacturing company, and we'd ordered 1,000 bicycle seats at $10 per seat. And now we've received them into inventory. All right? So we're going to plus them into inventory. That's an asset. And because we don't have to pay them right now, we're also going to increase what other account? Accounts payable for that balance. That's a basic journal entry that's going to do that. It's going to plus inventory, and it's going to plus accounts payable. Does that make sense? Accounts payable, which is what type of account? A liability account. Good. Now, pop this back up just so we can reference this as we're having this discussion. An example of an adjusting entry, a couple different examples. Unbeknownst to our buyer, when they actually ordered these seats, they were in this kind of discount window. They didn't know it. It didn't influence their behavior. But when we actually get the invoice sent to our accounts payable department, here's how it comes in. It says 1,000 bicycle seats, catalog price $10 per seat, minus 50 cents per seat holiday discount, promotional discount, which brings the net price of the seats down to $9.50. So what that's going to do is generate an adjusting entry that's going to reduce the value of the inventory, but also reduce what? The liability, how much we owe. That's an example of an adjusting entry. Here's another example of an adjusting entry. Now at the end of the year, like we're supposed to do with physical inventory, as part of auditing our books internally and then sometimes externally, we go out and actually count the bicycle seats. Now, of those 1,000 bicycle seats, 800 of them had turned into bikes that we sold. So how many bicycle seats should be left in inventory? 200. We go out now and actually count the seats, and there's only 150. What could have happened to the other 50? They could have walked out. Somebody could be building, ever heard that Johnny Cash song, One Piece at a Time, and didn't cost me a dime? So these are nice seats with gel. They could have walked out the door, right? Or somebody down on the manufacturing floor where they put the bikes together could have got a little excited with a box cutter, and when they opened up the seats, they ripped through that top layer. It's just they didn't have time to do the accounting transaction, and they didn't want it to come down on their shoulders, so they just kind of threw them away, and they made their way to the dumpster, and nobody actually accounted for it. Whatever, we have to adjust those off the books, right? So we have to take them out of inventory, and we actually have to, in this case, send a charge or an expense to the income statement to show that inventory loss. Two examples of adjusting entries. And we don't need to understand them in here to any greater degree than that. Does that make sense? Mm-hmm. Closing entries are a little more involved. But closing entries is kind of exciting. I know my pulse is increasing a little bit just with the prospect of talking about it. Closing entries actually kind of bring this whole thing together, because here's what happens with closing entries. Closing entries, you see those two operating accounts down on the bottom? You see that? What I want you to do is draw a line from where it says closing entries down to the left side of that little bracket at the bottom of those two accounts. And here's what the closing entries are literally going to do. And below that bracket, here's what I want you to write. Bring balances to zero. Now go to the other end of the bracket and draw a line up to the equity accounts. And what I want you to write along that line is take residual 2. And by the way, let me use this as an opportunity before I describe what you've just done here to answer the question that's popping up in some of your minds right now. Why didn't he just create the workbook with this already drawn in it? Well, let me ask you that question. Why didn't I? That's right. There's a very special thing that happens kinesthetically when you do a lot of writing and you create these diagrams yourself. You hold on to it longer. The kinesthetic brain activity of actually drawing and writing in your workbook, you'll hold on to this stuff longer. So you guys willing to kind of hang with it? Do a lot of all this extra writing? Yep. Give your partner a high five, handshake, or hug. Say, yeah, I'm willing to write all day long. Say in this month, we had revenue, so we had a revenue balance in there of $10,000. We sold $10,000 worth of bikes, right? And we had an expense balance at the end when we did the closing entries of $8,000. We had $8,000 of expenses. What's the difference between the two? $2,000 of profit, right? Does it make contextual sense to you or just general sense to you that when we bring those balances to zero and close those operating accounts out to zero, we're essentially taking that profit up to equity and it's increasing the value of our business? Last thing I'd like you to write up near equity. Equity has two parts, okay? The part that investors put in directly and the profit that we keep in the business that builds up over time. Does anybody know what that profit that we keep in the business that builds up over time is called? Retained earnings. That's absolutely right. And actually write that right next to equity, because that's what changes when we close out and take that residual up. It actually goes into an equity account called retained earnings. Does that make sense?